Hey, good morning, everyone. This is Pat Dolan from Delancey Street. I wanted to thank you for joining us today for the Industrial Tech and Manufacturing Industry Outlook. Again, I'm Pat Dolan. I'm a managing director with Delancey Street Partners. We're an M&A advisory firm based here in the suburbs of Philadelphia. I would first like to start out by thanking Blank Rome for sponsoring this industry outlook. And with that, we have a great panel today. I'd like to bring them to the stage and introduce them. So we have Chip Grace from May River Capital, CEO of Gerard Daniel Worldwide, and Michael Morrissey, who is a managing principal with Inverness Graham here in the Philadelphia area. Morning, guys. How are you?
Well,
Morning, Pat.
Thanks, Pat.
Thank you.
And we are technically sound. Everyone can hear each other.
Yep.
Great. So why don't we go around the horn really quick and we do some brief intros. Chip, you want to start us off?
Sure thing, Pat. And thanks for having me. Real pleasure to be here. So May River Capital is a Chicago-based industrial growth-focused private equity firm. We focus on lower middle market industrial growth businesses. These are generally founder, family, entrepreneur-owned companies with EBITDA between 3 and 12 million. Thank you.
Great. Tim?
Good morning, Pat. Thank you. So I'm Tim Kardish. I'm CEO at Gerard Daniel Worldwide. I just helped as an investor and operator acquire Gerard Daniel Worldwide with the backing of Graycliff Capital out of the New York area. I'm a serial CEO that typically works inside of private equity businesses where I help the company professionalize and bring it to contemporary best practices, ultimately taking it from a founder, owner, operator, eventually into a strategic acquirer. Good to be with you, Pat.
Great. Michael?
Thanks, Pat. It's Michael Morrissey. I'm a managing principal at Inverness Graham Investments out of Newtown Square, PA. Inverness is a lower middle market, growth-oriented buyouts firm that's invested probably about 40% of our portfolio is industrial technology companies. We are on our fourth fund. It's a $420 million buyout fund. I've been with Inverness since 2000. Prior to that, some experience with Bain & Company Consulting. And today, we continue to look for companies, typically 3 to 15 million of EBITDA, and probably about 80% of our companies are founder-owned.
Great. Well, thanks, guys. We have about 6 or 7 topics. I figure we'll go around the horn, make this as conversational as possible. So please feel free to chime in as you see fit. So, Tim, maybe we can kick off with you, but high-level topic. Discuss an example or two of past investments in technology that helped your business navigate all the challenges in 2020. So from an automation perspective, controls, software packages, et cetera.
Thanks, Pat. An area is we try to focus on both the cash aspects of the business and the people aspects. Not only at Gerard Daniel Worldwide, but in prior assignments, I've used a system called Predictive Index to help us talent optimize the organization and get the right people into the right chairs with the right instinctive behavioral traits. And then we use that tool to ultimately develop people further in those roles. Of course, we've used various CRM packages to help us automate our sales processes, which is, of course, particularly important in these times, these COVID-19 times, where you don't have that opportunity to ultimately be in front of the customer the way you might traditionally be. And most of our customers here at Gerard Daniel, as well as prior assignments, are fairly long sales cycles. And as a result, there's a lot of engagement that's required through managing opportunity projects all the way through to fruition. So having a CRM system that helps us to really manage the activities associated with engaging the customer and bringing them through full commercialization has helped us quite a bit.
That's great. We're actually users of Predictive Index as well. Chip, how about you, just from a what you've used over the past year or so to help you navigate this stuff with your platforms?
Sure, Pat. Yeah, so I would say, number one, we've been operating with a fairly defensive posture when it comes to new investments for the last 3 years. We had expected there to be some type of recession in the offing over, the coming years, going back to, 2017, give or take. Obviously, we had no idea what lied ahead with respect to COVID and the effects of the pandemic. But, that did inform our investment decision making over the past 3 years or so, and accordingly, we were willing to make the trade, to essentially pay up for businesses that we determined to be more resilient or embody characteristics that, whether it's recurring revenue streams, software, revenue streams, some type of MRO type attribute, or perhaps an end market orientation that we determined to be a little more resilient in the face of an upcoming recession. So that's been our mindset for the past 3 or so years, and thankfully it turned out to be a good strategy in light of the pandemic. Again, obviously we didn't expect this, but certainly we've weathered the storm quite well. We're essentially flat across our portfolio of 6 companies, both on a revenue and an EBITDA perspective. But again, kind of focusing our businesses on those attributes of their business models, whether it's replacement parts, whether it's MRO service or other features, whether it's charging for software more readily. We've really been trying to enhance kind of that whole aftermarket and recurring revenue stream aspects of many of our businesses.
Great. Michael, chime in, please.
Yeah, so for us, the one advantage of being on Fund 4 is that we lived through 2008 and 2009, and with essentially the exact same senior management team, the partner group. And so we've lived through that. So going into this, March 13th was Judgment Day. It was Friday the 13th. That's when Philly shut down. And so what we did is we reached out to every portfolio company, and we asked them all to forecast if their top line was down 50 or 15 or 30%, what would they do to hold their bottom line flat? And what was really interesting is a bunch of our companies are not in the Northeast or on the West Coast, and they thought we were speaking in a foreign language. So the Midwest was totally unaware of the sensitivity that we had in the Northeast or on the West Coast. And so from there, we switched to weekly portfolio company updates, and we built a matrix, the matrix of the things we wanted to talk about every week. And that's what we wanted: a market feedback, we wanted an operations update, a reforecast based on the 15 and 30s, liquidity and covenants, downside mitigation, cost cutting, and then opportunities, which actually was the most interesting part of the matrix, which was where are you going to go to take advantage where others might be flat-footed. Our businesses, overall, we're probably flat on the top and bottom line, but our companies that are more national in nature, more manufacturing in nature, are down, probably 15% on the bottom line. Our dental company had 5% of the sales they normally do in April. So 5% the prior year. And so that's how we went into it. Unfortunately, we are still, it's not a weekly cadence anymore, but we don't believe we are fully out of it yet.
Yeah, so that's interesting. I think it's this time frame can be viewed a little bit about getting your house in order. Everyone's always thinking about that, but maybe you can kick us off here with the importance of investments in technology, lean continuous improvement, cliche industry 4.0, to drive really stronger profitability, operating leverage, getting that good ROA. Can you comment maybe how you've used this period to think about that?
Yeah, was it Rahm Emanuel who said never waste a good crisis? So we across our 6 businesses, I just did some quick digging, and we've actually either materially upgraded or completely implemented an ERP system in 5 of our 6 businesses. Now, some of that was unrelated to COVID. Some of it had to do with some of our 2019 acquisition activity on an add-on basis, but we've certainly taken this time to invest in ERP systems, overall business processes and systems. We have kind of a go-to lean, mixed model lean implementation firm that I think is engaged in 3 of our 6 platform businesses currently. Again, kind of unrelated to COVID, but certainly doesn't hurt to be, focused on those types of things given the broader environment. But we've made a lot of investments across the board. We typically, if we find an opportunity during due diligence that we can hit right out of the gate by way of a specific expenditure, it might be, spending $1 million on software product development, might be a specific CapEx spend to implement automation into a given factory that doesn't have it. We'll pre-fund that amount at closing, put that cash on the balance sheet and hit it right out of the gates, coming into a new investment. We're closing a packaging deal hopefully in the next month or so, and we plan to fund a couple, $3 million to the balance sheet day one to implement some automation and a few kind of strategic capital expenditure type initiatives, so we can hit that kind of in the first 100 days.
Michael, you hit on some of it, but any things you guys have been doing within your investments just to quote unquote get the house in order a bit more?
Yeah, so I mentioned the dental company, and the business was down so dramatically. What I did is I pulled out our weekly update notes. And, I think for the first 45 days, it was really just hold on. And I don't think they mentally switched to, we were talking about it, but they didn't really actually start executing on performance improvement. So unfortunately, they had to let go. They brought back a bunch of people, but they had to let go a significant amount of the manufacturing workforce because literally there was nothing to ship. And they had built inventory already. But I just looked back, and so by June 15th, they were re-implementing essentially a fishbowl inventory system. They were finishing up a barcoding across the entire facility. They had also optimized manufacturing, cells for when people came back to work. So it was really an all hands on deck. Now that we have a sort of an empty house, let's redo it right. And when we bring back people, let's kind of reset our entire manufacturing operation. And what was nice is we were able to bring in an operating partner to parachute in for a couple days a week to really help facilitate that. And so I'd say we saw that in a few companies. We accelerated the closure of a sort of underutilized facility at our lighting business, reorganized that back into a corporate office. So, we have tried to take advantage of that. But at the end of the day, the companies, it didn't come back that fast, and you took advantage of the time to get the house in order.
Thank you, Tim. Your perspective?
So I'm an individual company operator, but have done this multiple times. Most recently, before Giardino, I worked on behalf of Argosy and NewSpring, and before that, Coppermine Capital. But I'm a guy that comes in and quickly wants to implement lean continuous improvement. This business at Gerard Daniel Worldwide, frankly, if I mention the word lean, they said, do you mean a piece of meat that doesn't have much fat on it? So, I'm in the process right now. Believe it or not, we acquired this business August 27th. I already have 3 lean Kaizen events already initiated, taking place. And I like to move at a very fast clock rate, if you might imagine. As you know, businesses that you acquire, you're looking at what needs to be done in the business to bring in cost efficiencies and waste elimination. And it's not about people elimination. It's about ultimately streamlining the operation in such a way that we take out waste. So we've got a lean event here that's going on around the workflow of our distribution center. And just for the sake of the prior ownership operating of the business, I won't mention our inventory turns, but as you know, when you acquire businesses, every challenge is an opportunity, right? So I'm the guy that says that's a challenge, we'll make an opportunity out of it. Our inventory turns are far below industry or benchmark standards. And so we're doing a lot of lean, Kaizen. And the other thing is, you probably know, you have to go through an educational process with your people. So we actually use the local DVRC or MRC, or actually out here it's Mantech, these local Pennsylvania-based organizations that actually get funding from the state of Pennsylvania as well as their own consulting to actually do Lean 101 training. So we have, going through the organization, funded by WEDNET. So we're getting dollars back from the state of Pennsylvania and applying that, growing and developing our people. Because when people say, what does lean mean? You have to give them at least a hands-on workshop experience. And we're already, again, we're not even completed month 2. And we've actually got one Kaizen event that we're midstream on and 2 more that will start within the next week or so.
So, Pat, one of the things that we see, and I'll hear occasionally, not all the time, but companies, they're too busy to do the project with the day job. And Chip, you're talking about like setting aside, X dollars to implement a new ERP system. One thing we always push back on that, because ultimately you have the process of making the company better is part of the day job. But it's certainly during the pandemic, that excuse went out the window.
Right.
I mean, there was time to implement everything that was on the wish list, frankly.
Yep, it's a time where everything's got to be pulled out to make things work.
Yep.
A lot of chatter out there, guys, just on the supply chain, whether it be disruptions, opportunities. Michael, maybe you can chime in on this one. What have you been seeing in terms of your portfolio companies, how they've been impacted by supply chain issues or problems?
Yeah, so we have a company that's in the lighting business, and I'd say 95% of U.S. lighting fixtures and lamps are coming from China. And so tariffs were put in place probably 2 years ago. That was kind of the first step. Unfortunately, they don't anticipate that relations are going to get better regardless of the new president. And so when we look and think about how do we diversify our supplier base, the fact that we can't go and visit in many cases, we think that's going to make it much more difficult to move operations or to diversify. One of our companies right now, we'd like to do a tuck-in acquisition in Ireland. We can't even go visit. And this has been a deal that's been floating around for 7 or 8 months. So it might be an opportunity for those who have relationships already in China, but we are actually proactively trying to diversify away. We may move some operations near shore to Mexico, just to avoid the sort of potential issues that there could be, going forward. I also think we invest in some medical manufacturers. I think there's going to be a push to have more of that onshore and less reliance on overseas sources. And so that might be an opportunity, frankly.
Tim, I imagine you have some good insights here.
Thanks, Pat. So it's interesting. As I look at Gerard Daniel and the prior portfolio companies that have responsibility 2 and 4, one of the challenges that, frankly, we're faced with the challenge of tariffs because we're a wire mesh and wire cloth company. And the challenge with it is that is a commodity from us from China. We do the value-added services. However, there are companies that are in Europe that ultimately do have trade sales in the U.S., and they're not exposed to the same tariffs that are currently on us on product that we're acquiring. So frankly, the tariffs have actually, and then to Mike's point, we can't get to China to ultimately figure out how we're going to either migrate what they're doing. And frankly, based on us trying to move upmarket to be really designed into our customers' requirement, we really are dependent upon those supply chains. We've not had, because we have such long lead time in goods, the disruption we've not had a shortfall in getting material that we need to do value-added services to. So it's been and again, for me, I'm not even here 2 months, but the challenges are the tariffs have actually worked against us actually being able to compete with the niche competencies that are resident within our organization, and has put us to some degree at a disadvantage of other markets where the tariffs are not as, where our competition are not facing the same tariff challenge. In fact, it's interesting. One of our Chinese weavers is actually trying to set up U.S. operations so that they can have a incorporation within the U.S. and they could potentially bypass the tariff. So that's a little bit of the tariff supply chain challenges that we're facing and some of the things we're trying to do to mitigate them.
Chip, how about your portfolio?
Yeah, so we did experience within a couple of our portfolio companies, some disruption in supply, largely from Asia. It was it was probably 45 days before Mike's reference to Judgment Day, the March 13th. It was kind of late January, early February, which also I think coincided with the Chinese New Year. There was, some complication there as well. So we did have a little bit of a disruption there. It was probably a few weeks, and then we started to essentially pay in advance with some of our Asian suppliers, which prioritized our items above others. And we really didn't experience at the end of the day much disruption whatsoever, thankfully. I do think that whether it's, the pandemic or kind of the broader geopolitical environment with China, the tariff situation, intellectual property concerns, I think the pandemic has expedited, the movement to alternative low-cost country sourcing. There's no question about that, whether it's, Vietnam, near sourcing with Mexico. We're thinking about opening up a sales and service office in Asia. At one point, we would consider Taiwan or Hong Kong as a likely, location for that, maybe 2-3 years ago. Now we're thinking Singapore. So I do think it has, expedited a lot of these, issues, condensed the timeframes, and forced action on behalf of a lot of companies that may have just kind of kicked the can for the next couple of years and see how this thing plays out.
Some of the Asian suppliers have moved out of China themselves, frankly, and so they're seeing that that's a risk, and they're taking that on their own.
Tim, we'll go back to you for this next kind of a two-part question. Just the competitive environment. What have you seen out there in terms of, as a middle market company, and with this is a middle market audience we're largely speaking to, have you seen from, much larger cap competitors, if you have them, Fortune 500 type competitors, has there been significant pricing pressure, other competitive threats? On the flip side of that, has this been an opportunity for you to take some market share, you to figure out some opportunities to be on the offensive?
So a good, as it relates to competition, Gerard Daniel, which serves North America and Ireland right now, and we're looking actually for an acquisition across the rest of Europe because it would be a great geographic and technology complement. The thing so Gerard Daniel is the largest provider in the market space. So potentially we're the most vulnerable because of the fact of the scale. And we probably represent around 35 to 40% of the available market coverage here in North America. What I would say is, in fact, because it's still quite early, I'm actually asking the team that represents our products in the marketplace to really look for, let's say, competitors who are facing the challenges that it's either labor, where we might be able to pick up somebody inexpensively that gives us reach into a new market. As it relates to overall pricing strategy, again, if you might imagine, being here a little bit less than 2 months, even though I've tried to bring in contemporary best practices around stratification of customer profitability, we're just at the beginning of that journey. Frankly, this is a company that didn't necessarily adequately differentiate what type of service it gave to its top 20% versus bottom 20% of the customers. So I'm still trying to work through understanding the customers in quadrant 1, which would be large, profitable, and strategic, versus the ones that are in quadrant 4, which are small, unprofitable, unstrategic, and trying to help the organization. I mean, some of it's straightforward and obvious, but as a result, I probably don't have as quantitative of a view right now of where I think pricing is vis-a-vis the current COVID-19 conditions. But anybody that's on this call that might be in banking that knows of companies in the marketplace of doing something around wire mesh or wire cloth, I'm certainly very interested in any thoughts you have of companies that are looking for someone to potentially take over the reins that might give us reach into markets or applications we don't currently serve.
Chip, how about you? The competitive environment, both sides of it?
Yeah, I don't know that we've noticed a difference kind of, during COVID with respect to the competitive environment in terms of what's happening kind of in the field of play. I think it's just generally competitive. I would say on a deal basis, kind of a transactional basis, I think all of us kind of experience that, April, May, June quiet period that, it seemed like the deal market was shut off. It started to come back kind of August and September. I have heard, and we've, certainly witnessed a number of strategics that I think just kind of put the brakes on. Strategics meaning corporate buyers, put the brakes on in the spring for any M&A. And a couple of processes that we're now in were as a result of those strategics basically pushing away, and back in, kind of March, April. And we were able to engage with those companies over the course of the summer, which is obviously, to our benefit. Now, I do think a lot of corporate boards, publicly traded company boards are now, trying to pressure their C-suite to, get back into the game now that things have stabilized to some degree. So it'll be interesting to see how that plays out. But I think for good quality companies that have a good COVID story, that weren't impacted materially to the negative, that are flat to up, I think those are still very valuable businesses. And I don't expect it'll have a major impact on multiples. In fact, there may be an argument that those companies that were up over the course of 2020 are perhaps more valuable today.
Sure. Michael, how about you?
I completely agree. You see the companies that are coming out now, they're getting incredible values for the companies that are resistant. I don't know if those are really manufacturing. It's more kind of technology or industrial technology companies, the technology side. We were able to close 2 deals between March and June. One is a cleaning supplies company, which is positioned well, and the other is a medical contract manufacturer that does interventional products. And we actually sold a company that was in online education, and that market is through the roof. That company continues to be up significantly versus prior year. We don't really see Fortune 500 companies. Oftentimes they're not the ones. The bigger companies are not the ones that we're really competing with. They're the ones that we're trying to take share with. If you think about the lighting space, the GEs and Sylvanias of the world are just not really that nimble. And so I think in COVID, high levels of service, webinars, I think we'll talk about it in a little bit, but the ways to get in front of your customers, Zoom training, I think our small businesses were able to pivot to that and those opportunities quicker than a GE was able to do it. Now, I'm sure GE's all over it now with their resources, but in a lot of these businesses where you're selling a manufactured product, service is still way up there, and on the study as to what's most important to the customer. And so being, responsive and creative, I think has really helped, our portfolio companies during this time. And I'd say, I know our lighting business is taking share, but the overall market's not great.
Right. I think it's you give a good segue there, but just in terms of sales and marketing and sales teams having to evolve, if you've had traditional quote unquote road warriors out there, Tim, maybe you can kick us off talking about the transition to digital assets and client prospect commercial engagement. How do you deal with this? What's going to change going forward? Not everyone's getting on planes obviously anymore. How are you thinking about that?
So this might be what Michael and Chip have alluded to some degree, somewhat actually contemporary, if there is such a thing as contemporary conventional wisdom. We actually use Microsoft Teams and Zoom ultimately to engage customers through actually our sales process and actually hold the typical meetings. And it's interesting where if you had to get people together in I call it an analog format where you went to see them, if you might imagine, you didn't always get all the buying influences around the table at the right time to further a project. And as I mentioned, our sales cycles tend to be somewhere between 12 to 18 plus months because we're working on projects where we get designed in for manufacturability, cost reduction, and assembly. And that means we're collaborating with our customers on a print that actually gives us a unique advantage based on our manufacturing capability and our engineering competencies. So interestingly enough, because of the Zoom or let's say the virtual meeting environment, we find ourselves actually getting more of the key players at our customers actually available because of the fact that they don't have to break away. And, they, as we all know, we can kind of do sometimes things in the background while we're participating in these meetings. So frankly, as it relates to furthering, or maybe even shortening, it's still early here. I'm here less than 2 months, but what I'm observing, and I don't have the metrics on it, I think that we're actually shortening our cycle time from the point at which we get an identified opportunity all the way to full commercial validation and qualification. So it's actually, as to Michael's point, it's actually giving us potentially an advantage to companies that are less nimble in using digital assets as it relates to customer engagement and opportunity management.
Michael, you touched on the topic. Want to go a little bit deeper?
Sure. So as we look at it, in fact, we just hired a CEO from one of the medical contract manufacturers, and that has typically, it's called CMD. And he's looking and he's basically saying, listen, it's marketing now. It is not sales. None of that. We had rep groups. They cannot meet with anyone. The medical contract manufacturing companies that are in Minnesota right now who are open are having the engineers from the Medtronics of the world come to their facilities to work because they cannot go to their own office. And so this idea that, being small and nimble, and you can socially distance and wear a mask there, so you can be appropriate. But the reality is the big companies, they can't even do their work at the office. And so the other thing so beyond just marketing, it's account-based marketing. So some of our companies can go very broad for SMB customers with marketing, and others, you can identify who they are and go very direct and pointed to try to get in front of them with a white paper, a webinar, or something so that they actually inquire back to you so you can engage, probably with an engineer or a technical salesperson. But right now, business travel is non-existent. A backslapping sales guy, it's just not happening. And so we're kind of revisiting that at every company we have, frankly, regardless of whether it's a manufacturer or a technology company.
Sure. Chip?
Yeah, just to tag on what Mike said, I agree with everything he said. We are encouraging our teams to invest in, kind of the latest available, kind of video technology, converting certain parts of their facility into essentially virtual sales rooms. For example, some of our companies have a test lab that right now is being underutilized. So we're trying to use that as more of a sales tool. Investing in SEO, kind of driving traffic to websites, doing white papers, that are posted to our website, things of that nature that help drive traffic. Those are all investments that we're making at this point.
Great. And guys, just in terms of what's top of mind for you right now, in terms of your next investments to, from manufacturing, industrial technology perspective, improve your return on assets, what are you thinking about? Any investments that provide real-time actionable data, KPIs, performance productivity data? How are you thinking about that? Michael, maybe you can start us there.
So we've always looked at manufacturing, spec'd in, and at some level of recurring revenue, a nature of recurring revenue in the business. So it's kind of the bullseye for us has always incorporated something that allows us to invest in the future because we have a stable base, and medical contract manufacturing is like that. Dental's another really good market. That's two examples. But frankly, even with that, our appetite over the last 15 months to go after this 10x and 11x and pay me for my pro forma 2021 performance has really evaporated at our fund. And so not that we were throwing that around all over the place, but we would pay up for a good company, a company that's able, lots of customers, diverse. But today you look and it just feels like those good companies are being run up through the roof. And this is where it's not Fortune 500, it's just much bigger funds coming down market to buy small businesses that are good companies. So we're a little more conservative today on sort of what we're willing to buy in a pro forma forecasted EBITDA.
Chip, how about you?
Yeah, I think it's more the same for us, Pat. I think I think COVID has provided a test case for the resiliency of any business model, and so you've got some great data to look at that's in real time. Obviously, the pandemic is not over. I think we're probably good 9 to 12 months out for things to even start to return to kind of any sense of normalcy. So, we're being pretty cautious. I think, as it pertains to COVID related adjustments, those are a tougher putt for us, particularly for businesses that, aren't as traditionally stable, where it's harder to really kind of squint your eyes and see the validity of that particular adjustment. I think, Mike's point about the bigger firms coming down market, we're a similarly sized fund as Inverness Graham, and we're seeing that as well. And I think it's probably caused us to perhaps go a little smaller on the increment, call it 3 to 5 of EBITDA to initiate a platform if we see an opportunity to build it through acquisition, and if we can attract in talent into that business. And in some cases, if you're adding $1 million, $1.5 million management team into a $4 million EBITDA company, that's a tough proposition. So we have done that a couple times, and so we're over equitizing those types of businesses, with the hope of scaling them quickly and growing them through acquisition and organically to kind of grow into their team. So I think a lot of our investments will start out with, basically a construct where you've got a lot more management team than you do company. And then you're trying to, grow into that management team, if you will.
Great. Tim, just from an operator's perspective, I know you're 2 months in, but there's probably a ton of things you'd love to do from an operating perspective. But how are you thinking about as you continue your lean investments and technology investments, and how are you thinking about that over the next 6 to 12 months?
So this is the company, and I realize I'm being somewhat granular about Gerard Daniel, but it's maybe reflective of other businesses that you acquire. This was a company that had many acquisitions prior to Graycliff and I investing in this business. And frankly, they're very disparate operations. So I'm trying to stitch them together in one common Gerard Daniel approach to things at the same time, bringing in cultural shifts to operational excellence in every functional area. And the reason I'm doing that is ultimately so that when we go to make acquisitions, and we are actually looking at them, as you guys know, the journey from the point at which you make initial contact to getting it over the goal line, especially with founder, owner, operated businesses, is typically no less than 9 to 12 months, often 15, 18 months, because of the courting and making it attractive, especially with getting them to roll over. So we're using operational excellence internally to prep ourselves to be better equipped than the prior owner of the business to ultimately fold these in to get the accretive synergies that we would expect to get out of a business like Gerard Daniel Worldwide. One thing I'd like to say, and I realize that we may be running out of time, is that because I was a guy that sold a business with Argosy and NewSpring in 2019, and then began the journey to find another business with a whole series of different financial sponsors, I saw very healthy valuations from January 1st until Friday the 13th of March. And then, of course, the market went silent because all the investors were inwardly focused to make sure they were doing value preservation versus value growth. And then it kicked up again around June 15th to where I was actually working on 5 different acquisitions with different sponsors, of which this was the one that I was fortunate to be part of. What I would say is that the valuations that I saw from June 15th until we actually acquired Gerard Daniel were quite a bit less than they were from the beginning of the year. And frankly, of the ones that were high, what I would describe being an operator who understands acquisition, there was a lot of gamesmanship by the buyers that won.
Yeah. We have about a minute or two, guys, but maybe real quick around the horn, just in terms of human capital. It's been a tough period, even pre-COVID, with finding good engineers, technical personnel, a lot of engineering expertise. Do you still find it's still tough to find that good technical, those technical people out there, Chip?
Yeah, we do. And I think for top talent, there will continue to be a challenge there, Pat. And we have the added challenge that many of our facilities are located in what most people would think to be rural areas, particularly for you East Coasters. But so we have to kind of find that right fit. And we've been open to commuting execs, things of that nature in certain instances. But yeah, it does remain I think kind of the number one challenge for us going forward for top talent, be it engineers, CNC programmers, folks like that are well trained. And I think it points to a broader gap in our country, and I think it's going to need to get solved at some point over the next decade, as far as kind of retraining the workforce and kind of bringing trades back into the equation as far as what young people are going to be doing kind of out of high school and college.
Yep. Michael?
No, we've actually been adding at a few companies, some senior executives and improving our teams, frankly, during this. So we have found that other companies let really good people go, and so we've been able to pick up a few really good people, frankly.
Tim, how about you?
So I'd say 10 to 15% of my time is spent actually creating the networks within the community around community colleges and technical schools to ultimately make a pathway. Now, we operate in Pennsylvania, down here in South Central PA, and it is an interesting place. I'm not quite sure where the Mason-Dixon line. I think it goes north of Hanover and down around Hanover. So we do have pathways to find talent. And I just wanted to share, I've known my wife through most of my years, and she reminded me why she married me.
Yeah, you had me at EBITDA.
That's
pretty great.
That's why my wife married me.
Yeah.
Anyway.
That's great.
So Pat, you had, and I saw some of the questions on the sheet. I mean, so the biggest thing about people, so in the chat there were some questions about people, is that, our CEOs, when we look at the pandemic and I look at where the cost cutting came from, the vast majority of it was some variable expense and decisions around travel, around how we sell, trade shows. And so they really tried to hold the line there. We have a business that's down 15% on the top line, and, they haven't let a single person go. But at some point in time, the company needs to right itself. And the problem is this double dip, or whatever you call it, the fear that's been sparked throughout our country is just having people change the way they go about their lives in a way that's bad for business. Even if you opened everything up, my instinct is that it would not go back to the way it was, just because people have been polarized into the sky is falling or nothing's wrong. And that's not really where we are. We're somewhere in between. And so I'm hoping that things get better so that these guys who've been holding the line on people are able to keep the good people that they've been really excited to sort of build a team around.
Great.
Where do you get those EBITDA masks? That's one of the questions.
I'll send the link to you guys.
If this was a live event, I'd say we definitely would be giving away those EBITDA masks. I like it very much. Tim, thank you for dialing in all the way from Pennsylvania. Michael, Pat, and Chip, it was a great conversation. I do want to thank Lou Rappaport. And if your technology is working, God bless, there he is.
Here I am.
Oh,
Thanks, Stephanie. Thanks so much to Pat and our panelists for a great panel. I'm Lou Rappaport, co-chair of Blank Rome's corporate M&A and securities practice. We're a national law firm with a focus on the middle market and M&A in the ecosystem you guys all travel in. Please be sure to view the agenda for the afternoon lineup. Up next at 11:30 is What Does the Agenda Mean for M&A Deals? From here, you're going to return to the ballroom floor for networking. And please do stop by our sponsor table, first floor, table 14, and say hello. Thanks so much, everybody, and enjoy the day.
Thank you, Lou, and thank you, Blank Rome, for your support. Enjoy the rest of the day.